As of right now, Monday, April 27th, 2026, the markets are open and active. SoFi stock is currently trading at $18.42, showing a slight intraday dip of 2 cents or 0.11% from the previous close. While the surface-level movement looks like a quiet start to the week, there is a significant tension building beneath the ticker. Most investors are looking at this price action as a simple consolidation phase before the big quarterly report on April 29th, but the reality is much more complex. We are seeing a massive tug-of-war in the technical indicators, where a short-term sell signal is fighting against a long-term buy trend. This isn't just about waiting for earnings, it is about a specific allegation from short sellers that has institutional desks double-checking their spreadsheets. The common belief right now is that SoFi is a high-growth fintech darling that can do no wrong, especially after hitting that record $1 billion revenue mark last quarter. However, the reality you need to face is that Muddy Waters Research has thrown a massive wrench into that narrative. They are alleging that SoFi is using aggressive accounting to hide its true personal loan charge-off rates, claiming the real rate is over 6% rather than the reported 2.89%. If this reality holds any weight, it means the fair value gains that padded past earnings might be built on sand. This creates a curiosity loop for the upcoming earnings. Will management provide enough transparency to debunk these claims, or will the numbers start to leak the truth? Recent stock movement has been incredibly volatile, with the price fluctuating over 2% daily as we approach the end of April. We saw a heavy sell-off just a few days ago where the stock tanked nearly 4% in a single session, likely due to institutional players de-risking ahead of the volatility. Trading volumes have stayed elevated, averaging around 41 million shares, which tells us that the smart money is actively repositioning. If you look at the online investment landscape, platforms like Fidelity and Schwab Intelligent Portfolios are seeing a surge in retail interest for SoFi because of its all-in-one banking promise, but the price action suggests the big banks are more skeptical. Institutional activity is particularly interesting right now. We are seeing a divergence where retail traders on the Robinhood app are buying the dip, while larger Fidelity brokerage accounts are showing signs of distribution. This often happens when a stock is caught between being a growth play and a bank play. If SoFi is valued as a bank, its current price-to-earnings ratio is astronomical. If it is valued as a tech company, it looks cheap. This identity crisis is exactly why the intraday swings are so violent. The market is trying to decide which bucket to put SoFi in, and the short seller report just made that decision much harder. When we talk about online investing today, the SoFi Invest platform itself is a major part of the company's business model. They aren't just a stock you buy, they are a place where people go for investment help. They have successfully moved from being just a student loan refinancer to a full-scale financial institution with a national bank charter. This charter is their secret weapon because it allows them to use member deposits to fund their loans, significantly lowering their cost of capital compared to other fintechs. This is why their adjusted EBITDA grew 60% year over year. They are capturing the entire life cycle of a customer, from their first student loan to their individual brokerage account and eventually their mortgage. If you are using self-investing strategies, you have to look at the cross-buy rate. Last quarter, 40% of new products were opened by existing members. That is a massive efficiency metric. It means they don't have to spend as much on marketing to grow their revenue. But again, the expectation is that this growth is clean. The reality check comes on April 29th. If the personal loan originations, which reached a record $7.5 billion recently, show any sign of weakening credit quality, the stock could break below its current support level of $17.76. On the flip side, if they beat the 18-cent EPS estimate and provide a clean bill of health regarding their charge-offs, we could see a squeeze back toward the $20 mark. The competition in this space is fierce. You have the Robinhood trading platform fighting for the younger demographic, while Interactive Brokers dominates the high-frequency and professional crowd with lower fees. Fidelity Wealth Management and Fidelity IRAs remain the gold standard for long-term savers. SoFi is trying to sit right in the middle, offering intelligent portfolio options for those who want a SoFi robo-advisor to do the work, while also providing an active investing platform for those who want to trade SoFi ETFs. It is a bold strategy, but it requires a massive amount of capital to maintain. One thing that often gets overlooked is the SoFi mobile app's role in their ecosystem. It's designed to be sticky. Once you have your direct deposit, your individual brokerage account, and your credit card all in one place, the friction of leaving is very high. This stickiness is what justifies the valuation to many analysts. However, we have to look at the macroeconomic pressures. With interest rates potentially staying higher for longer, the default risk on those personal loans, which are mostly unsecured, is the biggest threat to the reality exceeding the expectation.
Please comment below with how many shares of SoFi Technologies you currently hold and what your average cost basis is. Do you think the Muddy Waters report is a legitimate warning or just a coordinated attempt to drive the price down before earnings? The business model relies heavily on the flywheel effect. They lose a little bit of money or make thin margins on the first product to get you in the door, then they make the real profit on the second and third products. Their loan platform business is now running at an annual pace of $15 billion in originations. That is a lot of volume to manage, and it is exactly why the bank-grade safety they advertise is so important. They were the first nationally chartered bank to launch a stablecoin, SoFi USD, which shows they are trying to stay ahead of the curve in terms of blockchain-powered remittances. Looking at the future outlook, there are two distinct paths for the stock over the next 6 months. Scenario 1 is the validation path. This happens if the upcoming earnings report clearly and mathematically disproves the short seller allegations. In this case, the stock likely breaks through the $18.94 resistance and heads back towards its 52-week high of $32.73. The catalysts here would be continued member growth, aiming for 15 million by the end of the year, and an expansion of their home loan business, which has already seen a 2x increase recently. Scenario 2 is the correction path. If the reality of their accounting is even slightly messy, or if the most accurate estimate from analysts, which is currently lower than the consensus, proves correct, we could see a drop to the $15 level. The risks here aren't just internal, they are sector-wide. If other fintechs like Robinhood or SoFi competitors show a slowdown in retail engagement, the entire online investing sector could take a hit. Institutional investors are very jumpy right now, and they will not hesitate to rotate capital out of fintech and into safer havens like Fidelity mutual funds or Fidelity ETFs if the numbers don't look pristine. The tension between expectation and reality for SoFi has never been higher. The expectation is a high-growth, high-tech disruptor that is eating the lunch of traditional banks like JP Morgan or BofA. The reality we are investigating is whether that growth is sustainable, and whether the accounting behind it is as transparent as it needs to be for a national chartered bank. We are seeing a lot of insider sentiment that is positive, with significant acquisitions by executives over the last year, which usually suggests they believe the current price is a bargain. But until that April 29th report hits the wires, the market is going to remain in this high-volatility wait-and-see mode. To summarize the central insights, SoFi is currently a stock defined by its contradictions. It has record-breaking revenue and member growth, yet it is under a cloud of accounting suspicion. It offers a one-stop shop for everything from investing sites to crypto, yet its core business remains unsecured personal loans, which are sensitive to economic shifts. The contrast between the optimistic retail narrative and the skeptical institutional positioning is what will drive the price action in the coming weeks. Whether you are using the Robinhood app for quick trades or Fidelity Investments for a long-term hold, the next 48 hours are critical. The expectation is a beat. The reality will be found in the fine print of the charge-off rates. This is a high-stakes environment where authority is earned through the data, not just the headlines. Stay grounded in the numbers, watch the $17.37 support level closely, and be prepared for a significant move once the earnings tension finally snaps. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.